Your second job is not automatically taxed at a special higher rate, but claiming the tax-free threshold twice can still leave you with a tax bill. We are going to look at exactly where you should be claiming that threshold, why that second paycheck always looks so heavily taxed, the exceptions to the rules, and the steps to fix a broken setup before tax time. The issue starts with a systemic blind spot. When you have multiple jobs, your employers operate in strict silos. The payroll department at Job A has absolutely no idea what you earn at Job B, and they do not talk to each other. Because of that total lack of communication, each employer calculates your pay-as-you-go, or PAYG, withholding based entirely on the isolated amount they pay you in that specific pay cycle. They assume their payout is your only source of cash. This creates a structural mismatch. You have fragmented withholding happening in isolation every week, but the Australian Taxation Office calculates your final liability based on your total combined annual income. That gap between what individual employers guess you owe and what the ATO knows you owe when it's all merged together is exactly what triggers an unexpected tax debt. This diagram shows how your income pools over the year. An eligible full-year Australian resident gets one general tax-free threshold of $18,200 applied against their total combined income. You do not get a fresh $18,200 allowance for every new job you take on. To manage this, the ATO has a general defense mechanism. You should claim that threshold from only one payer. Usually, you do this for the employer providing your highest regular income. When you do that, your second employer will withhold tax from the very first dollar they pay you, because they assume your main job is already using up the tax-free space at the bottom of the container. This leads to a persistent myth that Australia imposes a 50% penalty tax on second jobs. That is entirely false. The higher withholding on your second payslip is not a permanent special tax bracket. That first dollar withholding is simply a deliberate mathematical safeguard. It collects enough tax up front to offset the fact that you don't have a second tax-free threshold to lean on. Higher withholding on a second job serves as a prepayment strategy to prevent a massive debt when the ATO combines your income at tax time. Looking at this chart, we can see how the standard rule applies to Mina. She expects $52,000 from her main hospitality job and $14,000 from weekend retail shifts. Her total combined income of $66,000 towers over the $18,200 line, confirming she must claim the threshold on the $52,000 job only. Now watch the chart adjust for Leo. He earns $8,500 from one casual job and $6,000 from another. Both of his combined income bars sit comfortably below the $18,200 threshold line. Because Leo possesses reasonable certainty that his total combined annual income will not breach the limit, he meets a specific exception. The ATO rules permit him to claim the threshold from both payers. These scenarios apply strictly to full-year Australian residents. If you are a part-year resident, a foreign resident, or a working holidaymaker, you cannot rely on these defaults and must calculate completely different baseline obligations. Setting up your withholding requires actively projecting your annual income bracket, rather than passively checking default boxes on your paperwork. Here is a gauge comparing annual liability to actual withholding, demonstrating the trap. Sarah earns $45,000 from one employer and $25,000 from another, and she made a fatal error. She claimed the threshold from both. Because both employers withheld tax as if Sarah had two separate thresholds, her combined withholding is dangerously inadequate, leaving a flashing red gap that represents a pending tax debt. Even with the right setup, pushing your total combined income into a higher marginal tax bracket can still trigger a shortfall. Add in hidden variables like untaxed bank interest, annual bonuses, or study and training loan obligations like HEECs, and the accuracy of your daily withholding gets distorted even further. PAYG withholding is only ever a rough estimate of a future liability. Expecting it to perfectly match your final tax bill across multiple jobs is a critical vulnerability. If you find yourself trapped in a situation like Sarah's, the immediate rule is simple. Do not wait for the financial year to end before taking action. You must use the precise administrative solution shown here. Submit a new, valid withholding declaration to the relevant employer to revoke your tax-free threshold claim. This new declaration operates prospectively to fix your future pay cycles. You do not need to ask your payroll department to rewrite old pay slips. Submitting a new declaration is the only proactive way to realign your daily employer withholding with your actual annual tax reality. To catch a shortfall early, start with Step 1. Carefully estimate your total annual income from every payer and every source. Step 2. Confirm which employer currently has the threshold claimed by reviewing your recent payslips or contacting payroll directly. Step 3. Run those numbers through the official ATO tax withheld calculator to verify if your current withholding is adequate. And Step 4. If your diagnostic check reveals a likely shortfall, submit a new withholding declaration to your employer. This is general tax information, not personal tax advice. Check the current ATO guidance or speak with a registered tax agent about your circumstances. Monitoring multiple income streams is a continuous requirement. Keep track of your totals, adjust your declarations, and stay ahead of your assessment.